Welcome to the latest stage analysis video. It is Wednesday, the 11th of January, 2023. I'm going to do a little bit of a special feature as we come into the new year here, as there's what we call in the stage analysis method the forest to the trees approach. There's been a large amount of stocks and groups moving into early stage 2 over the course of the last week or so, and over the last few months, to be fair. So I thought it was, with the broader market showing signs of stage 1 behaviour, we now need to focus in on where those stage 2 breakouts are occurring and which kind of groups and sectors are leading. And kind of a big part of the stage analysis method is identifying those. So starting off with the major index tonight, which is the S&P 500 that we track. I just wanted to show the fact that this has now moved up to what we call a SATA score of an 8. So this is the stage analysis technical attributes score, which basically measures 10 different things to do with the stage analysis method. I won't go into the details of it, but basically everything from what we look for in order to identify whether the stock's in stage 1, 2, 3 or 4, and basically the various technical attributes to do with that. So basically, when it's above a score of a 7, it tends to be in a stage 2 type environment. Not always, but obviously it can still be in stage 1 or it could still be in stage 3, but it's a more favourable score, and the majority of stocks above a 7 tend to be in a more likely to be in a stage 2 environment, whereas when it's between 4 and a 6, it tends to be in a stage 1 or a stage 3 environment, a more neutral kind of thing, whether it's basing, whether it could still be within stage 2. You can see here we're moving sideways within stage 2 back in February 2021, for example. And then further on in the year, in June, it was moving sideways and into July. So the score dropped off back into between the 4 and 6 score. But then for the majority of the time through June, through obviously all the way back from May 2020 there, all the way through to it started to get more negative back in September 2021. It was in a more favourable technical environment, or more neutral. So that's how the stage analysis technical attributes works. And you can see over the course of the last year, it's been much more negative. We've been in a stage 4 type environment, and then started to move towards a stage 1 type environment over the course of the last 6 months or so, if not more, since obviously bottomed back in June back in 2022. So we're now back above the rising 10-week moving average and rising 30-week moving average. The SATA score has now moved up to a SATA 8 at the moment. So it's the highest score, as you can see, that it's been since all the way back in the top at 2021, December 2021 there. So we're looking for potential stage 2 breakout attempt if this can continue to improve. So which would be looking for a move above the near-term pivots here, so it would need a much stronger move through this 4,200 area at the moment, roughly. If we go into the S&P, the SPX chart, you can see we're just moving up. We've had a strong 4 days as we've started off the year here, moving up into the 200-day moving average. So we've got CPI coming up tomorrow, still underneath near-term resistance zone, and obviously the previous 2 pivot highs that formed above the 200-day moving average in early December there. So still in obviously a tentative position within this broad stage 1 base structure that has been forming for all the way back since June in 2022 here. You can see the percentage of the stocks above their 20-day moving average has now moved up to 83.6% on the S&P 500 there. So much, very, very heavily weighted on the long side there in terms of short-term uptrends for stocks. If we look at this from an equal weighted point of view, though, you can see it's a much more favourable position. So I've talked about this multiple times before. You can see we're only 1% away from the actual potential stage 2 breakout level on an equal weighted basis. So if it can actually move through this level either this week or in the coming weeks, then potentially we could actually make a stage 2 breakout in the S&P 500, although obviously the actual index chart itself might not be showing that breakout attempt, as obviously the mega cap stocks are holding that back. But the equal weighted index itself could actually make a stage 2 breakout attempt. And if we look at that on the daily chart here, you can see the percentage of stocks above their 200-day moving average is actually at 65% at the moment. So, and it's much further above, it's already above the 200-day moving average, and the 50-day moving average is crossed above. So it's already over 3% above its 200-day moving average, in a much closer position to its near-term pivot highs here that formed back in that late November, early December period there. So currently above rising 180R level, so in a short-term uptrend above its 200-day moving average. As I said, with 65% of stocks above their 200-day moving average in the S&P 500, means it's in either a stage 1 or an early stage 2 type environment. And as you can see, because we haven't broken the pivot yet, then that shows that we're potentially on the borderline at the moment. So we move on to part of the forest to the trees approach in Stan Weinstein's method, is to look at what's going on when we've got favourable conditions in the market, or neutral or favourable conditions, so either in a stage 1 or a stage 2 environment. So we're in a stage 1 environment. We then look down to what's going on in the sectors, what's going on in the industry groups, before then diving into the individual stocks. It's a top-down approach. So next up, you have the sector breadth, which I covered yesterday in the blog post for the members. So at the moment, it's obviously changed today, would have moved on a little bit, but it was at 49.4%, has risen 12.92% over the last 3 weeks since I last did it. So if we actually scroll down and see the previous post there, so we'll come back. We can see the change. Flick between the two. So this was 3 weeks ago, back on the 19th of December. You can see it was a bit more negative. We had more groups in the lower zone, and most of the actual sectors were in the neutral minus area, in the 40 to 50% range. If we go back to currently, you can see there's been a shift. So we've actually, majority of groups have moved up now. They've all come back through the 30% level. Technology, real estate and healthcare are the lagging areas of the market at the moment, and the basic materials, utilities and energies are the ones with the most stocks above the 60% level there. So by using this, it's a visual representation of what's going on in the market at the moment. So you can see we're in a very neutral position. We've got majority of sectors in the mid-range. So we've got 3 sectors in what we consider the stage 2 zone, which is above the 60% level. We've got 5 sectors, so financials, industrials, consumer discretionary, staples, communication services in the mid-range, in the neutral zone, which is stage 1 or the stage 3 zone, depending on which end of the scale it's coming from. And then we've got 3 sectors still in the stage 4 zone: technology, real estate and healthcare. So obviously this will continue to change, but at the moment this gives us a good proxy of what's going on in the market, which shows that we're in a very neutral position. Obviously tallies up with what we're seeing in the index charts there, with the percentage of stocks above their 200-day moving average, etc., that we saw in the S&P 500. So if I scroll down here, you can see the relative strength rankings at the moment in terms of how many stocks are above their 150-day moving average in each of these sectors. So this is not like the S&P 500 ones that you will see on the likes of barchart.com. Obviously the scans that I do cover much a larger amount of stocks. It covers the vast majority of stocks in the market. So for example, the basic materials, we've got 263 stocks at the moment. There's 170 above their 150-day moving average as of yesterday, whereas communication services over the last 3 weeks has been the biggest gainer and has moved slightly back above that 40% level. So 106 of the 260 stocks are above their 150-day/30-week moving average at the moment. So it's hence borderline between those stage 1 and stage 4 zones. Then at the other end of the range, you can see healthcare is our weakest area of the market here. So you can see we've got 33.05% of the stocks in the healthcare group are above their 150-day or 30-week moving averages. So, and this is a much different story than what you'll see in the XLV. So I highlighted this in the post here. You can see basically there's a massive divergence with what's going on between the XLV and the percentage of stocks above their 150-day moving average, as the XLV is actually doing really well, but the XLV only covers 64 stocks from within the S&P 500 large caps, whereas obviously we're looking at 1,159 stocks in this sample. So there's actually only a very small percentage here above, so 33.05% above there. So the XLV only covers 6% of those stocks that we're covering in this. So it gives a very, very different picture, as healthcare looks very strong. If you look at the percentage of stocks above their moving averages on the S&P 500 chart, it's actually near the top of the scale, whereas it's actually at the bottom of the scale if you look at it from a broader perspective. So if we look at the actual individual charts for this, these give you a bit more context of what's going on. It's actually been a bit of a change of behavior going on recently with the communication services. You can see how we change this to full view here. Basic materials is our strongest area. You can see obviously the big move that it's had up since that October low there. So it's been continuing to strengthen, and the pullback was fairly shallow. So now back above the 60% level, coming out of that lower zone. So showing good strength there. Whereas communication services is just moving out of this lower zone, has now made a few little higher highs here, starting to pop up through that 40% level there. So coming out of this lower 30% range, which it's been in over the course of the last year. So was one of the weakest areas, potentially the weakest area for a very long time in these sector breadth posts. You can see how it came off from the highs back in late 2020, early 2021 there. So now starting to see a little bit of a change of behavior here. So it's definitely one area to keep an eye on and drill down into a little bit more to see which stocks are making those changes. So energy, on the other hand, coming off from a stage 3 type top area here. So you can see when you're above the 70% level, it's the higher risk zone. You start to come out of that. So this has been chopping around. It did make it down to the lower zone very briefly, but unlike the rest of the groups, hasn't spent any time in the lower zone particularly. So this still showing stage 3 type behavior in the middle of the zone, but obviously still quite strong at 60% or so at the moment. Financials, on the other hand, spent a lot of time in the lower zone here, and you can see it has come out strongly, started to move up. So currently just under that 60% level. So in the stage 1 / borderline stage 2 type area there. Industrials also has been strong recently. You can see a big move out of the lower zone here, spent a lot of time in that lower zone last year. So started to come out over the course of the last few rallies and starting to show in the mid-range again. So in the stage 1 type zone there for the majority of the industrial stocks at the moment. Whereas technology been much weaker, still one of the weaker areas of the market, as I said earlier. So just coming out of that lower zone, you can see it has improved, but hasn't yet made it back through the 40% level into the mid zone. So still just tentatively in the borderline area between the stage 1, stage 4 kind of area. We see a strong move back into the mid zone there. Then that would be more favourable for the technology stocks. But it has definitely been a lagging area, as we've seen from the watch list posts. So staples, still mid-zone at the moment. It has come out of the lower area. There's some gaps in the data in some of these, which you'll see. So there was a few which I haven't got the full data for. But at the moment, this, again, mid-zone here. Real estate coming out of the lower zone again was one of the weakest areas, again potentially the weakest area for a little while, starting to come back out again, but still fairly weak, only just above the 30% area. Utilities popping up now back above the 60% level, but chopping around. It's a much smaller group than some of the others, whereas healthcare continues to remain weak, as you can see, still holding in the lower area really, so still below that 30%. Not below it, but just above that 30% level, but just chopping around in the lower zone. We need to see a lot more strength from this to start getting more favourable on healthcare again. Need to start breaking these highs that it formed back in. That's the August high. It's nowhere near its August high at the moment. So definitely an area of weakness in the healthcare. And consumer discretionary is another area where we've seen a change of behaviour. This is coming out of that lower zone, showing higher highs, higher lows. So starting to show a change of behaviour over what we saw through 2021. Right, let's move on.